Ladies and gentlemen, we're diving down into the powerful tax advantage tools that you have capable to you as a Canadian going into 2023, as we're going to be updating the TFSA, the RRSP, your CPP. We're going to be talking about the first-time home buyer's account and something called tax loss harvesting. If that is a conversation you think you'd appreciate, hit that like button, folks, because first and foremost, taking the broad view of my portfolio going into the tumultuous markets we're experiencing through December, I have a net worth value of around $365,000 before my cash position. But taking a look at the heat map of my ETFs, my individual stocks, we are seeing this downtrend start to pick back up, at which I'm going to be more aggressive on buying. But you guys have seen my portfolio before, and what you're going to start hearing from many YouTubers in the finance space, they're going to start mentioning something called tax loss harvesting. And I want to refine this down into a very simple fashion. Let's presume you were like me. You held Tesla stock for a few years. You ended up taking some profits at the beginning of 2022, but the rest of your diversified portfolio, whether ETFs or individual stocks, are starting to downtrend. What you can do, and we're going to use VOO as an example here, basically you can write losses off against your gains to waive the taxes, right? And how do we do this efficiently? Well, if you have a position like VOO, the S&P 500 index, you could sell it for this 20% loss if you held it since the beginning of the year, write it against those Tesla gains. However, you might not want to be out of the market for 30 days because it requires that you do not buy back the same security within 30 days, but you can buy the counterparty ETF FSPY, which is exactly the same ETF, but from a different product offering, which the government looks at is a completely different position, which is really, really cool and kind of a little bit of a loophole tactic. If you guys want to learn more about tax loss harvesting, I've been using this free platform from Global Predictions. It's called Portfolio Pilot. It gives you risk assessments on a portfolio score, will offer recommendations to better balance your portfolio. It does break down the components of my individual ETFs, but what it also does is they recently just launched the taxes beta, which is going to give you an idea between your gains, losses. It's going to give you further insight into tax loss harvesting and how you can save up to even $3,000 in tax credits. On top of that, you even got simulations so you can back test your portfolio against prior crashes, whether it was the 2008 financial crisis, the dot-com bubble, or even the recent March 2020 crash in the pandemic. But I'm going to leave the link to this powerful free portfolio tracker in the description below, along with more articles on tax loss harvesting. But let's get into the actual tax advantage accounts you have capable to you as a Canadian. First and foremost, the TFSA, and this is all coming from the Canadian government website. If you've never heard of a TFSA, this tax-free savings account allows you to earn money. You pay taxes on that money. Then you can contribute a specific amount into this tax-sheltered account, at which you can make capital gains and dividends completely tax-free. You can draw against at any point in time in your life. And as of 2023, for the first time since 2019, they're going to increase the limit by another $500, allowing you to contribute $6,500. If you don't know what your total contribution limit is, you can log into your CRA account and it'll tell you exactly how much you're able to contribute. And same with the RRSP. If you've never heard of a registered retirement savings plan, in contrary to the TFSA, the RRSP allows you to earn income that you probably pay tax on. When you put it into this tax sheltered account, you'll actually get a refund on those taxes, at which you can earn capital gains and dividends tax free. But when you decide to pull money out of this RRSP, that's when you're going to pay taxes, and you only pay your nominal income tax rate, which is really cool. And they've also increased the limit for this from 2022 from $29,210 to 2023 to $30,780. However, the caveat to this is it's based off your earned income, so you'll have to make around $160,000 to $180,000 to actually fully capitalize on this, because it allows you to contribute about 18% of your total earned income each year. And again, log into your CRA account to get more details. Now let's discuss the least favorite of the bunch, the CPP, the Canadian Pension Plan. This gets automatically deducted from your earned income, and you're never going to see a benefit from this until you reach the age of 65. They auto invest for you, and I have to admit, the Canadian Pension Plan invests hundreds of billions of dollars and has done so very successfully, keeping up with pace of the S&P 500. As of 2023, they increased the amount they're going to take from your paycheck to 5.95% on the first $65,700 earned. This is up from 2022 with the 5.7% they were taking from you. And I know if you're trying to do the financial independence to perhaps one day retire early, this is a bit of a hindrance, but you have to imagine this kind of takes the control out of your hands to some degree and puts a cherry on top of the cake for when you do reach that retirement age of 65. So it is just something to look forward to. This is something my parents are starting to collect checks on every single month, and just be grateful that the Canadian government does benefit everybody to some varying degree, even if they don't know how to invest. But putting the CPP aside, there is another really fun account coming out in 2023 called the First Time Home Buyers Account. And this is incredible because because it takes into consideration the tools of the TFSA and the RRSP and kind of combine them together. And I'm going to break this down for you with first and foremost the contribution limits to this. And you can only take advantage of this if you've never bought in a house. This is literally for first-time home buyers. So if you actually bought a rental property, but you were renting and you never lived in the rental property, that means you've never bought a permanent residence, and you can also take advantage of this. But the lifetime contribution limit is going to be $40,000 with an annual contribution limit of $8,000. And basically the way this operates, if you put money into this account, you're actually going to get the taxes back the same way you would with an RRSP. And then similar to a TFSA, you're going to be making gains, dividends completely tax-free. But as like a TFSA, when you draw that money out of this account to buy a house, you're not going to be paying any taxes on it either. So it really kind of combines the best of both worlds with the TFSA and the RRSP together. So this is something that I will definitely be taking advantage of through 2023 as just another tax advantage to my earned income. Now, this can be very technical, very complicated. I always advise sitting down with an accountant, but I've been very pleased to partner with Global Predictions on their portfolio pilot project here, giving you some insights which many platforms don't into the taxes, as so many of you asked me about how you figure out capital gains and losses. So this very powerful tool is going to help you manage that. But at this point, I do want to pass the question off to you, because all of these tax advantage accounts will literally save you hundreds of thousands of dollars over a 30-year period. And I'd love to know how you're taking advantage of it. But stay cool, stay awesome. And as always, I look forward to catching you in the next one.